Have you ever wondered how to hedge your account? In today's video, we're going to be discussing just that. Welcome to the Options Trader Lounge, where we talk about generating income and growing your wealth within the US stock market using options. Thank you all for tuning in. Get yourself a drink, sit back, and relax. Now let's get into it. As we know, the stock market can be very volatile. In moments' notice, the market could move up or down, and depending on what side we take, it could incur losses. So the whole concept of hedging allows one to mitigate the risk and the potential losses against your account. Because you have a hedge on, and if you're implementing it correctly, you can potentially safeguard your investment and sustain the long-term growth and profitability of the account. The reasons why you want to put a hedge on is to mitigate risk, preserve your capital, smoothen out volatility, and to protect yourself from unforeseen events, such as a black swan event, where the market can rip to the upside or to the downside and can incur substantial losses against your account. So because you have a hedge on, and if you do it right, you can limit the losses and allow yourself to trade another day. So how do we implement a hedge? Well, first of all, you got to figure out what is your trading style. Because my trading style is more of a trend following strategy, what I like to do is to only put on a hedge in moments of the market where we see extreme greed or extreme fear. Other than that, I'm continually following the trend. If the trend's direction is higher, I will always place a direction to the upside. When the market pulls back, I'm looking for entries where there's a dip to support where I could buy back in for a potential run to the upside. However, when things start to get euphoric, such as when we start to see a lot of participants among traders who do not see the potential risk, if people just keep buying and buying and buying, that is when I like to implement a hedge. But other than that, I'm not necessarily looking for a hedge to be placed on my positions to mitigate the potential risk to the downside. Because the concept of that I like to use is to preserve some capital during those moments of pullbacks. But during the moments where things start to get euphoric and people seem to not see the downside risk, that is when I like to start implementing hedges against my account to protect myself from a rapid downwards move in the market. So as we know, trading options, the whole concept of option trading is to first understand the underlying instrument that you are trading. The option market moves based off of the underlying instrument, and that is how we get the pricing of the options. So if we were to place a hedge, let's say at this moment in time, right, we've seen, first of all, we'd like to identify, are we in a moment in time where we are seeing a euphoric moment, meaning that people just have lost the perceived potential risk. That is how I like to see euphoric moments, where you're just seeing buying after buying after buying with no pullbacks in the market. Well, when I see these moments in the market, what I like to do is to implement some risk management strategies, such as hedging my account. Generally, during this moment in time, I would see this as a potential buy. However, when things get to certain extreme points in the market, implementing a hedge would be wise. And so to implement a hedge, a simple hedge strategy, what I like to do is to open up debit spreads. So to open up a debit spread, what we are going to do is pick a expiration date on the triple Qs. I generally like to trade within the 15-day expiration. So we're going to look at the July 14 expiration. That's 16 days out till expiration. And I want to hedge to the downside. Because we know that the general market is in the uptrend, we want to put a hedge on in the event that the market may make a sudden move down. And because I have a hedge, what I'm trying to do is to preserve my capital by mitigating the loss. So overall, we have to first understand that in a directional market, I am generally net directional of the overall trend. But because we want to put a hedge on to preserve our capital in the event that we may see a black swan event, we want to put a trade that will make money on the move down. So we are going to open up a put debit spread. So to open up a put debit spread, what we are going to first do is what I'd like to do, because hedging your account should not be an expensive task to do. We want to choose the cheapest and most efficient way to hedge your account. So we are going to open up a debit spread, and by opening up a debit spread, we are first going to buy, hold on here, we are going to buy buy a strike that is out of the money and sell another strike that is down below. So we're going to go to a $5 wide spread, and we are selling the 345 and buying the 350. By doing this, we are opening up a put debit spread. And the way this works is that if you've seen our previous videos, we're generally selling put credit spreads. We are making money in the direction if the market were to move up. But in this case, instead of selling a put credit spread, we're going to be buying a put debit spread. By buying a put debit spread, we are spending $41, and $41 is our max loss, but our potential upside is $459. However, just by looking at this alone, I do not expect to collect the entire $459. What I am doing here is spending just a small amount of dollars, spending $41 to possibly protect my account if we were to see a move down. And the way this would look like if I were to open up this trade right now, I'm essentially not trying to make any profits at all. All I'm doing is spending a little bit of money, and if the market pulls down, I'm making money to protect myself from losses. Again, I'm not expecting to collect this entire $459. And in fact, the way to collect this entire $459 is if both of these strikes go into the money by expiration. But I am not trying to look for a big move to the downside. In fact, I will probably only collect 2 to 3 times the amount of the max loss and close the position entirely. In fact, what I'll do at this point is I'll be looking for a potential put credit spread, because overall the direction is still to the upside, right? We're just hedging to the downside in the event that the market will pull back, and by doing that, I'm preserving my capital to trade for the long term, make the small gains, but also mitigate the risk, right? Because in trading, profits are not 100% certain. There's always going to be times where there are losses that we have to take as traders, and losses are part of the game. And we need to know how to accept those losses. And one way to accept a potential loss on your overall net long is to place a hedge. And this is a perfect strategy that anyone can implement into their option account. So if you like this video, please go ahead and share this video if you find that this video could be useful to a friend. I would greatly appreciate it if you could share this video. Also, make sure you hit the like button down below, because it will definitely help out with the YouTube algorithm. And we will see you on the next one.